So a couple months ago, my 11-year-old son comes to me and says, "Dad, I want to invest in stocks." Now, in case you haven't noticed, by me building a website and a YouTube channel, I'm a bit of a financial enthusiast, so I was intrigued by his interest. "So why do you want to invest in stocks?" I asked. He said, "So I can buy a car." Now, I thought this was a great idea. And granted, 5 to 6 years isn't a very long window to actually invest in stocks, but I thought it would be a great opportunity for him to learn and have some skin in the game so he could, learn from the ups and downs of the market. But we quickly ran into a problem. Where do you open a brokerage account for a kid? They can't legally do that until they're 18 years old. So at Vanguard, we looked at maybe setting up brokerage accounts in my and my wife's name, and then just sort of having separate ones for our kids that we could invest in stocks in. But the problem is any capital gains, dividends, or short-term gains that they realize will be taxed at my wife and I's tax rate. And in the back of my mind, I knew about UTMAs and UGMAs anyway, which is basically an account that allows you to put assets aside for a kid. It becomes their property, but then any growth on that is actually taxed at their income tax rates instead of the parents. And naturally, a child who doesn't work is going to have a lower income tax, capital gains tax, dividend tax than their parents probably do. Now, when you open an UTMA or an UGMA, a custodian is appointed. Usually it's the person that opens the account, which is usually the parent. That custodian actually manages the account on behalf of the child until they reach the age of majority for their state. Now, for many states, this is age 18, some it's 19, some it's 21. It just depends. You'll have to look that up based on where you live. Gifts to an UTMA or UGMA actually receive the annual gift tax exclusion of $18,000 per person, and be $36,000 for a set of parents that can give money to a child without any gift tax implications or any counting against your lifetime exclusion. Once in the account, the assets can actually be invested, and the first $1,300 of gains or earnings is completely tax-free because that's the standard deduction for a child who's claimed as a dependent on another tax return. The second $1,300 is taxed at the income tax rate of the minor, so that's usually about 10% unless they have a really great job for a teenager. So for example, let's assume that there's a couple in the 24% tax bracket and they want to give $1,500 to their kid. $1,000 of that is from long-term capital gains. $500 of it is from non-qualified dividends. Well, $1,000 is going to be taxed at their long-term capital gains rate at 15%, so that's $150 in tax they're going to pay for that piece. The $500 of non-qualified dividends is going to be taxed at their income tax rate of 24% because it's a non-qualified dividend. That's going to amount to $120 for a total tax liability of $270 for the parents. Now, if these earnings had come from assets that were already held in an UTMA, then the total tax liability would be completely different. First off, it's $1,500, so the first $1,300 would be completely tax-free. There's no liability for that whatsoever. The next $200 is taxed at the income tax rate of the minor. So you got a 10% income tax rate or a 10% non-qualified dividend rate. Either way, it's only a $20 tax liability versus the $270 that the parents would have had to pay, yielding a $250 tax savings just by channeling the money into an UTMA or UGMA before they realize those earnings. There's a few things you need to keep in mind about UTMAs and UGMAs. First off, the gift is irrevocable, meaning you can't undo it. Once the money goes into the account, it can only be used for the benefit of the minor that's the beneficiary of the account. You can't take it back for anything except for their benefit. The other thing to remember is once the child reaches the age of majority for your state, they get total custody of the account. You no longer have any say in how it's used, so they can use the money however they want once they reach that age of majority. Any assets in an UTMA or UGMA are considered the property of the minor child, so as they approach college age and begin applying for financial aid, that will actually count against them a bit as they look to fund college, so keep that in mind as well. And with that in mind, I would encourage you to consider a 529 to save for college instead of an UTMA or UGMA, mainly because the 529, any earnings in there are completely tax-free, period, if they're used for education. In an UTMA or UGMA account, even if you use the money eventually for education, as they yield earnings or produce earnings, they're actually going to pay tax on that. Even at the kid's rate, it's still going to be higher than nothing, which is what you would get in a 529. So a 529 is perfect for saving for college. Don't use an UTMA for that. The last thing I want to focus on is that the assets inside of an UTMA or UGMA can be used before a child reaches the age of majority as long as it's used for their benefit. It's important to know because if you're saving for something for the child to use somewhere in their teenage years, like a car maybe, you can pull that money out as long as it's used for their benefit. Now, with that said, you can't exactly put a child's name on the title of a car in most states. At least I don't think you can. So if you're a parent and you're trying to get the money out of the UTMA, but the title is actually in your name, that could create a lot of legal things. So talk to an attorney about that. I don't know all the ins and outs of that legality. It's just a wrinkle I thought of. But other than that, If you're using the money for the child's benefit, you can pull it out of the UGMA account at any time. In the end, we chose to use an UTMA account for our kids to invest in. We're really looking forward to their interest in these accounts as they watch them go up and down and pay taxes not at their parents' rate. In fact, they probably won't pay any taxes for a long time because they need quite a balance to have earnings that would call for taxes. But anyway, we're glad they've got it. If you want to set one up yourself, they're pretty easy. If you already have a relationship or an account with a brokerage, just call them and tell them you want to set up an UTMA. You'll need your kid's social security number in a few minutes on the phone or on the internet. If you don't have an account somewhere already, it'll probably take a little longer. I think you'll have to set up your account first before you can establish one for the child, but you'll have to check with the custodian on that. Now, if you found this video helpful, please click like and subscribe below so I can continue making content that helps people learn about finance. Don't forget we have tons more on our website at martinmoney.com. As always, we're thankful for your interest and your time. God bless and take care.